Across the vast, sun-scorched plains of Texas, the air ripples with heat and voltage. The wind tastes of dust and electricity. Power towers stretch endlessly along the horizon, carrying energy through thick transmission lines that hum faintly in the dry air. And at the end of those lines lies something unexpected. A cluster of colossal data centers under the name IREN, a company born in Sydney, Australia. But this is no ordinary industrial site. IREN's infrastructure includes a 345 kilovolt power intake system designed not for short-term crypto mining, but for large-scale, continuous computing. Its data centers are built around immersion and liquid cooling systems, the same type used by top-tier AI supercomputing facilities. Here, the very air shimmers with the hum of energy, and the metal conduits seem to breathe under the strain of unseen current. This isn't just a data campus. It's the physical manifestation of a long game, one that bridges renewable power, infrastructure engineering, and artificial intelligence. Founded in 2018, IREN began as a renewable energy-powered crypto mining firm, capitalizing on cheap electricity and efficient hardware management. In November 2021, the company went public on the NASDAQ, attracting global investors eager for exposure to the growing digital infrastructure market. But the following year, in November 2022, disaster struck. The company received a default notice from its lenders. For most mining firms, that kind of notice marks the end. Typically, creditors seize the rigs used as collateral, power contracts are terminated, and properties become stranded assets. The usual playbook is clear. Sell what you can, restructure debt, and downsize operations to survive. Yet IREN did the exact opposite. Instead of retreating, it kept its power infrastructure intact. Not only that, it expanded it. The company maintained its 345 kilovolt transmission lines, continued construction on new substations, and even acquired additional land. To outside observers, this move made no sense. A company under financial strain was doubling down on its most expensive assets. And that became the first mystery. Why hold on to and even grow infrastructure when liquidity was vanishing? The conventional wisdom says that during distress, companies prioritize short-term solvency over long-term assets. They cut high fixed costs, sell equipment, and renegotiate energy contracts. IREN ignored that playbook entirely. Analysts proposed two theories. First, that IREN had always viewed power infrastructure, not mining, as its core business. Second, that even before the default, management had already anticipated the AI computing revolution, quietly pivoting its foundation toward it. In either case, it meant one thing. IREN was playing a longer game than anyone realized. By 2024, the outlines of that strategy began to emerge. IREN announced a major pivot to AI cloud computing, revealing plans to deploy around 800 NVIDIA H100 GPUs, the same chips that power leading-edge AI data centers. The company unveiled an ambitious roadmap: a 750-megawatt campus in Childress, Texas, a 2-gigawatt expansion site in Sweetwater, and continued operations at its hydropower-based facilities in Canal Flats, Mackenzie, and Prince George, Canada. But here came the second mystery: the order of execution. Normally, companies start by securing GPU contracts. Then, as the hardware delivery approaches, they expand power and cooling capacity. Infrastructure follows hardware, always. But IREN reversed the sequence entirely. It built out its power grid and cooling systems first before the GPUs were even secured. This inversion defied logic, or at least traditional logic. Building infrastructure ahead of demand is costly and risky. Idle megawatts translate into wasted capital. But this move also revealed something profound. IREN wasn't speculating. It was betting on a structural truth of the computing economy, that power and cooling are now scarcer, more strategic assets than chips themselves. In today's AI arms race, GPUs can be delayed, resold, or upgraded within months. But substations, transformers, and liquid cooling systems take years to build. By completing those first, IREN effectively locked in future capacity. It traded time for certainty. Yet the gamble came with a steep risk. If utilization lagged, depreciation and maintenance costs could erode its balance sheet long before new revenue arrived. Then, in the fall of 2025, IREN made its boldest move yet. It raised $1 billion through convertible notes and secured multi-year client contracts for its AI cloud business. Revenue guidance jumped past $500 million annualized, and GPU inventory expanded from about 20,000 to over 23,000 units. The company also confirmed plans to transition to NVIDIA's next-generation Blackwell architecture, cementing its position among high-performance computing firms. At this stage, most companies would release detailed technical schedules, power-on timelines, rack density data, cooling efficiency tests, and hardware delivery milestones. But IREN stayed silent. The information gap became its third mystery. Why the secrecy? Optimists argued that IREN's silence reflected confidence, that its infrastructure was so far ahead, operations could start the moment GPUs arrived. Pessimists countered that the lack of detail might hide delays. Chip shortages, firmware optimization issues, or uncompleted substations could all be pushing back real revenue. The truth likely lies between these two extremes. But the answer to this mystery will not come from press releases or projections. It will come from one physical moment, when power truly begins to flow. When electricity surges through those lines, when coolant begins circulating through immersion tanks, when racks hum to life under full computational load, that's when the theory turns into reality. IREN's journey reads like a deliberate experiment in inversion, from its 2021 NASDAQ debut to the 2022 default, to its 2024 rebranding and AI cloud expansion, and its 2025 convertible bond issuance. Every chapter reveals a company systematically exchanging short-term speculation for long-term infrastructure. And this strategy matters deeply. In the economics of AI, power cost and cooling efficiency aren't side notes, they're the main levers of profitability. The companies that control energy, land, and data capacity will define the next decade of computing. IREN is betting that by owning those fundamentals, it can outlast the volatility of both crypto and AI hardware cycles. Now, only one question remains: utilization. When will those megawatts turn into revenue? When will Childress's substations light up? When will Sweetwater's expansion site fill with racks? When will Canada's hydropower plants deliver steady, low-carbon baseload energy to feed it all? When those conditions are met, the mystery will dissolve, and IREN's true value will finally come into view. IREN's playbook breaks convention. It built the foundation before the product. It valued electrons over chips. In a market obsessed with instant performance, it built patience into infrastructure. That decision could prove reckless or visionary. Only time will tell. For investors, the real signals won't appear in the stock chart. They'll appear in the voltage across the grid, in the efficiency of the cooling lines, and in the uptime of those GPU racks. That's where the truth of this company lives. Not in sentiment, but in current. The Valuester channel is inviting you to join this conversation. If you know of any listed, unlisted, or pre-IPO stocks or cryptocurrencies you think deserve our next deep dive investigation, leave your suggestions in the comments. Your input shapes the stories we uncover next. And to all of you who watch, subscribe, like, comment, and share our videos, thank you. Your engagement keeps this channel alive, growing, and curious. This was Valuester.